Hey everyone, welcome back to the Chain Reaction Podcast. I'm your host, Tom Shaughnessy, a co-founder at Delphi Digital, where we're 5 full-time analysts focused on institutional crypto research. If you aren't a subscriber, you're missing out, so visit the site while you're listening. One quick housekeeping item. This podcast is strictly informational and educational and is not investment advice or solicitation to buy or sell any tokens or securities or to make any financial decisions. I may personally own tokens that are mentioned on the podcast, and you can view the show notes for our full disclosures. With that out of the way, today I'm thrilled to have on Kyle Davies, who's the co-founder of 3 Arrows Capital. We get into Kyle's entire history, his whole finance background. We go into all the strategies that 3 Arrows Cap is deploying to drive alpha, which goes way beyond just long and short positions. And we also go into the bull case for LEO. So full disclosure, I do own tokens in LEO, but it was a very interesting conversation. Kyle unloaded a ton of great insight and analysis for us, and I think you guys are really going to like this one. Let's dive in. Hey everyone, welcome back to the podcast. Today I'm thrilled to have on Kyle Davies, the co-founder and chairman of 3 Arrows Capital. Kyle, how's it going?
It's going great, Tom. Thanks for having me.
Yeah, thanks for coming on. It's early for you, late for me, but crypto never sleeps. So tell us how you got started in crypto. I know you have an interesting backstory here.
Yeah, so I first heard about Bitcoin in 2012 and first started buying Bitcoin in 2013, but to me it was still like a fun thing. It was definitely not serious. At that time, I had just started my fund, 3 Arrows Capital, with Suzu, and we were doing pretty well in FX markets. So to me, it was actually much more of a distraction. And it turned out to be actually a distraction. We were trading on an exchange which went bankrupt. It was ICBit, and that was not a great thing to be happening when actually my core business was doing pretty well. So turns out I was wrong. In retrospect, it would have been nice to accumulate a lot of Bitcoin back then. But yeah, we didn't get going again in crypto until 2017. When we spun up the same desk. We trade a futures basis trading desk. So we're doing BitMEX, OKX, Huobi, crypto facilities, CME versus each other and versus a spot market. And to support that, obviously, we run a borrow and lending desk as well. So we have we're borrowing from several top 15 ICO treasuries directly, and a number of other counterparties as well.
Wow, it's super interesting. I definitely want to get into borrowing from ICO treasuries. I haven't heard of that before, but going back to the early days with Suzu, I mean, what was it like starting this at a young age, and how did you grow it into what you have now?
I was coming out of a bank. I was 3 years at Credit Suisse doing derivatives trading. I was trading things like accumulators, knock-in, knockouts, structured products. And Sue actually started same group, same desk, same boss as me. And then ended up going to Flow Traders, which is an ETF ARB fund. And this was right after the financial crisis, so we were pretty clear that we wanted to do something on our own. Banks weren't paying as much as they used to. And we thought the obvious answer was a hedge fund. So in 2012, we started a hedge fund. Just assumed we were going to raise lots of money and trade the markets. And it turned out that it was really hard to raise money, and we could make it faster than we could raise it. So we ended up not raising money. We had to take one small ticket at one point, but we returned it within 4 months. And pretty much ever since, we've been running only our own money.
Wow, that's incredible. Yeah, you don't hear too many stories where, you hear a lot of stories today in crypto where people raise too much money and they don't know how to manage it, let alone not being able to raise that much and just being able to make it faster. That's incredible. Yeah,
smartest guys I know in crypto are all trading their own money for the most part. I think the reality is that crypto, we were trading FX back then, so it was much more liquid. But it turns out in crypto, the liquidity of the underlyings that you're trading, and it depends how much you're trading or the frequency with which you churn positions. But the liquidity is really just not there. Maybe for a couple of coins like Bitcoin, maybe, but if you're trading anything else, the liquidity is really not that great. So turns out you can max out your positions pretty quickly.
Yeah.
And it's expandable upon tech and expandable upon ideas, not expandable upon capital.
That's a really good way to put it. And diving into one area that you guys focus a lot on is futures. Walk us through like how this works for those that are new to it and what you guys are doing here.
Yeah, absolutely. So we, the way I think about it is, why does Bitcoin have an interest rate? Because that would be the front end of the curve, right? Why does Bitcoin have an interest rate? And the reason for me is two reasons. One is if the futures are trading at a discount to spot, so futures below spot, backwardation, then you can borrow Bitcoin, short Bitcoin, buy the future, lock in a premium. And you can afford to pay an interest rate equal to whatever that premium is, right? So that would be one way. That's not what's happening right now. We're in a bull market now. Futures are trading at a premium. So you should actually do the opposite trade. You should borrow dollars and sell futures by spot. But the other reason is Bitcoin can be used as collateral on a number of different exchanges. And based on your return on capital from trading on these exchanges, you're willing to borrow at a certain rate. So that's the second reason. And I think that's why Bitcoin borrow rates have been anywhere from 4.5% to, let's say, 11.5% over the past 18 months. Other coins are different. So let's say Ethereum. Ethereum, in relation to its market cap, only really has one major use case as an interest rate, and that is if the futures are trading in backwardation. If they are not, you can't use Ethereum as collateral on many different exchanges, and so there's a much larger supply, and thus a much lower interest that people are willing to pay for it. Unless, of course, if it goes into backwardation, in which case people pay a lot for it. And the same is true of other coins as well. So that's the way we look at it. Because we're trading the futures basis, we will look at, let's say, BitMEX as the benchmark. And if we look at how that's trading in relation to other futures markets that we also trade. And then we'll do a spread trade, basically, either future versus future, or more likely future versus a spot market to lock in that rate.
Super interesting. And for those that aren't the finance pros in the room, or might just be more focused on the tech, Kyle, what's the reason for messing around, or not messing around, but trying to profit in the futures market versus just buying and selling Bitcoin on an exchange? I know it's probably a lob of a question, but I'm sure people are probably wondering.
Yeah, absolutely. So we do have core long positions. We are long Bitcoin, we are long Ethereum, Leo, and Polkadot. Those are our four main core positions, which are all pretty substantial and pretty long-term thesis. But that is an entirely different mentality. I mean, that's like a back book, long-only passive book, which we don't really trade around very much. Us as a firm, we are looking at doing some sort of arbitrage trading. So, whereas one firm might be a market maker of spot, another firm might be a market maker of future. Well, we would be a market maker of the premium of the future, which you could think about, the premium of a future, you could think about as the market sentiment. If the market is really bullish, then people will buy the leveraged product, which is a derivative. If they are bearish, then they will sell that product. And so the sentiment of the market can be thought about as the premium or discount of the futures market, and that's what I'm market making, the premium.
Gotcha. Okay, that's interesting. So, there's a lot of talk between high frequency trading, algorithms, set protocol just launched on Ethereum, and people are kind of getting a hint of, how they could automate their portfolios. How much of what you do on a day-to-day basis is automated, or is everything you do, you and Suzu's choice and manual approval on everything here?
We do try to automate as much as we can. So we've written to all the exchange APIs here. That said, a lot of what we do, and our alpha, pretty much since inception, has always been a hybrid of being able to algorithmically trade something and have an OTC supporting it. So, for example, for if you want to do, let's say the future, they're trading in backwardation. You want to borrow Bitcoin, short it, buy the future. You need to be able to borrow Bitcoin. So how are you going to borrow that Bitcoin? That's an OTC transaction. That you need to go onto a chat, negotiate with a counterparty to lend you Bitcoin at the best rate that you can get. So I want to be, you negotiate the collateral terms, you negotiate the rate. If they're taking credit risk on you, then you need to show your financials. We're an MAS regulated fund, KPMG audit, monthly administration. And that's important because if someone's taking credit risk on me, they need to understand how and what that is. Or I post more collateral and then they don't take credit risk on me, right? And so our alpha is always the hybrid of that. It's always the algorithmically trading the future across various premiums, but then manually on chat in a very archaic way, negotiating and trading the borrow that we would do on the back of that.
That's interesting. So it sounds like, you open the podcast with, you guys have a lot going on in your fund. You do the futures trading, you do borrow and lending, you have these long positions in Bitcoin, Ethereum, Polkadot, and Leo. But it sounds like all of these components are all interplayed and kind of necessary for you guys to have alpha, because if you need to go to an OTC desk, you're also borrowing and lending yourself. And if you need to short it or trade it, you guys have relationships with all the APIs already set up. Is that kind of the good way to think about it? And do other funds have all of these components built in as well? Or is this like a differentiated strategy?
Yeah, no, I agree. So it is important to have all of that together. And there are other firms. There are absolutely other firms that do this. Many prop trading firms try to do the same thing. I think one thing that we say that we do better is because for legacy reasons, we have an 8-year track record. We are regulated as a hedge fund in Singapore by the Monetary Authority of Singapore. And we have, an annual audit and a monthly administration by top, 2 or 3 fund administrator and auditors in the world. We're able to access the market in a different way than someone that has, let's say, a shell corporation, BVI, with no track record and a small amount of assets in it. Other people try to compete in this, but at the end of the day, this is a balance sheet intensive game. And that's part of the reason I like it. You can't, if you want to market make spot markets, then you don't need a large balance sheet. You need really good tech. Your tech might be expensive, and you need a good trading team too. But you don't need an enormous amount of capital for that. Whereas for a futures basis trading desk, you absolutely do, because you can't cross margin that trade, right? If you're long futures and short spot or vice versa, those are 2 separate positions which you are margining on different exchanges usually. So that's why it's a participation game. Anyone that is participating in the game makes some amount of money on that trade if they can do all the components at the best rate. But it's optimized on balance sheet or on the quality of the entity you have, and on the execution, your commissions, your ability to negotiate the best rates. It's optimized on a number of different levels.
That's awesome, color. And, it's kind of funny you're talking about, going into Telegram chats and negotiating OTC deals when, we all thought that everything would be, automated by now and we wouldn't be dealing with people and, goodbye Wall Street. Do you think that, what, I guess, era would you put crypto funds at infrastructure wise versus traditional hedge funds? Like, is the tech and the relationships on the same level, or do you still think crypto is a little bit behind?
So I want to separate prop trading firms and hedge funds. I think that prop trading firms generally trade their own money and generally have, let's say, higher return profile strategies, usually more expensive tech, higher volumes, and they can more akin to like a high frequency trading firm or a broker mentality. And those firms, I think, are absolutely on par with the rest of the world in other assets because they are those other firms. Jump trading is absolutely dominant in many different asset classes. Well, guess what? They're also dominant in crypto. Same thing goes for Tower. Same thing goes for a number of other HFTs as well. So in fact, I would challenge if you're not from that background and you are starting your own crypto trading firm without the background of an HFT, setup, I would challenge how you're even going to compete. What makes you better than the number one trading firm in the world that makes $1 billion a year for the past decade? What makes you better than that guy?
Yeah, that's a good call. It doesn't take that long to get up to speed on crypto.
Yeah, so I would say the largest HFTs in the world will dominate the largest crypto HFT markets as well. There's always pockets of ways to make money. We have our pocket; other people have theirs, but it's a niche. And then for hedge funds, I think it's different. That's a completely different. That's like an asset allocation game. And that's really not what we do.
That's a good. Yeah, I haven't really heard that much of high frequency trading firms, the traditional ones, being involved in crypto. It's probably a little naive of me, but what % of the large ones do you think are involved in crypto today? Do you think like the majority of them are, like you talked about, or do you think that if they do enter, they just will be dominant because of their nature?
They're there. I think every prop trading firm or HFT has thought about it, or has a group that's active right now. And they've been there for, it maps very well to FX markets, crypto. Also maps reasonably well to futures markets. They're already there, basically. The way you can know this is go try, you used to be able to do spot versus spot arb, right? Like let's say, a Gemini versus a Coinbase spot arb trade. Go try to do that right now. That's gonna be within, the comms of those exchanges, which means that if you pay commissions after doing that arb, you didn't make money anymore. And that's because there's other HFTs in there that are running market making across all exchanges at all times on all pairs. So yeah, I would say very much being done right now. That's
awesome. And let's move on to the borrowing and lending side. You mentioned earlier that you guys are borrowing and lending directly from ICO Treasury balances. How does that work, and why are you guys doing this?
So the ideal, let's say if we're borrowing, the ideal lender for us is someone that is sitting on a bunch of coin that is not earning anything. And they're sitting on it for a couple reasons. One is they're just bullish, they're long, they're high net worth. Two is they're an exchange and they need to do this for their business. Or three, they're a treasury that raised a bunch of money, plan to spend it at a future date, but not right now. And anyone that's just sitting on, let's say, Bitcoin or stablecoin, actually stablecoin is the highest demand right now. But if you're sitting on dollars or stablecoin or Bitcoin, those should be lent. And if you're worried about credit risk, you can even ask for full collateral back. So you don't take credit counterparty risk. And what I mean by that is, let's say you lend, let's say $1 million worth of Bitcoin, and someone will give you $1 million worth of some collateral back, let's say Ethereum, so that you are not taking the credit risk on that counterparty. It has to rebalance, obviously. There has to be a margin call level in case the Bitcoin Ethereum spread were to move. But you get to earn interest on your Bitcoin. And that basically is what a lot of treasuries are doing right now.
Wow, I always thought that a lot of teams just kept the money in a wallet, used it when they could, and usually ran out of it faster than they thought. I didn't know that they were actively making like treasury management decisions. Is this like a common practice for the large projects, or is this kind of, if you're able to find one, then great?
No, this is quite common. So the treasury management, there's a couple different ways you can think about it. But one way to think about it is you could do covered calls. We have not endorsed this. We don't. I think there's a number of pitfalls of doing that kind of style of margin trading or treasury management. But what we do endorse and which we do support is borrow and lending markets. It's a win-win situation. If you're sitting on a coin that's not earning anything, I will pay you for it. You will not take credit risk on me if you don't want, or you can see our balance sheet and take credit risk on me, and I'll give you a higher rate. And then so I can make money on my side, and you make money on your side. It's win-win. That's why we can borrow directly from ICO treasuries, or we can borrow from a number of other platforms as well.
That's awesome. Yeah, I know. We spend so much time, like the crypto native people, just looking at, DeFi and Dharma and, Compound and lending there. We kind of forget about just the massive market of existing ICO balances. Like some of these projects raise hundreds of millions of dollars.
Yeah. And we do borrow from lending platforms as well. I mean, if you're retail and you're lending, I don't know, $1,000 or $10,000 on like BlockFi or Celsius or something like that. Well, what do you think those guys do with all those tickets that they raise? They can't just pay interest without earning it somehow. They lend it to trading firms on the back, like me. So, yeah, I mean, at the end of the day, all the interest has to add up at some point, right? So, and you can do that on DeFi platforms as well. We are active on a couple, but it's just, I think that market's not quite there yet. And for two primary reasons. One is WBTC has not taken off yet. The liquidity is peanuts. Maybe that will change, but as of right now, it's really not there. And the other is DAI is very expensive to deal with. For us, we need to be trading with USDC or Bitcoin, and we can convert the DAI, but there's always an expense in there that just makes it non-feasible, basically.
That's awesome. Yeah, no, I'm blown away because it sounds like you guys are like a really innovative fund and it's your own capital. It's just amazing. And you're in every part of basically finance meets crypto world here. It's awesome. But let's go on to one of your holdings. I've had people on to talk about Bitcoin, Ethereum, and Polkadot. Let's discuss Leo. What got you interested in LEO and what's your take on it?
Yeah, absolutely. So Leo is the Bitfinex token. It's a utility token. It's also a buy and burn token from revenue, and it's a debt token. It's a recovery token on a couple different events. And the reason we liked it is for me to understand the nitty gritty of tech is hard. I'm not a tech guy by my nature. So I'm comfortable owning something like Bitcoin and Ethereum, but I am not comfortable going down to the 30th, 50th, 50th, 60th, whatever coin and try to decipher, that tech. That's hard for me to do. So we don't do it at all. But for me to understand Leo is quite easy, actually. And I can value, let's say, the debt component of it. One way that you might think about that is, for those who don't know, there are two ways that Leo can accrue debt-like returns. One is with crypto capital funds. There's $850 million US, which is currently frozen with an injunction by the New York Attorney General. There's been a couple of different cases, or not cases, but court judgments on this. Right now, there's a 3-month extension, at which point the judge can file from the bench, or it can be thrown out, or it can be continued. It can be extended. But if that were to be returned, 95% of that $850 million would be used to buy and burn Leo. And when I think about that, as a debt, I just look at the holders of Leo. So there's one firm which put in. So Leo was $1 billion in 10 business days. One firm put in $250 million. 5 firms put in over 50%. I have to believe that those firms have pretty good reason to believe that those crypto capital funds are coming back. And we have spoken to them as well. But yeah, as a debt token, if you're putting a substantial amount of money into an instrument which is not that liquid, it's only trading, let's say, 3-4 million a day, you really have to believe on that capital coming back, right? In addition to that, Leo is a utility token. It's used as a portfolio margin on Bitfinex. It's also used for trading discounts. The more Leo you hold, the lower your trading fees. And there's a couple other programs that are coming out as well. For example, it will be used to raise funds in TokenX, the IEO platform. It will be prominent in the derivatives platform, which is in the process of launching. So it's also a utility token.
That's an excellent overview and very succinct overview. I love that. And Kyle, when you're thinking about the potential return from crypto capital, the 850 million. Let's say that gets returned. Let's say they use it to buy and burn Leo. I guess it's a high quality problem for people who hold Leo. And full disclosure, I do own some personally. But what do you think would happen to like the price? Like you can't just go out and just start buying this on the open market. The price would just explode and they wouldn't be able to buy that back. Do you think they would just negotiate with these smaller concentrated firms that made major purchases, or how do you think this would all go down?
The short answer is I just don't care, because I think when those funds come back, I am going to be so happy that it will not matter the exact way that they do it. If they were to, like you said, if they were to try to buy, let's say, approximately $800 million of Leo on Bitfinex's open market, which is trading 3 to 4 million a day, and they have to do that in 18 months, according to the white paper. If they were to do that, the price would absolutely explode to crazy levels, and then, of course, afterwards, it would crash to crazy low levels, right? So I do believe that there's probably going to be some way that is not done. Maybe some of the larger holders will start to put in offers at certain levels, or maybe it will trade OTC, right? But at the end of the day, it just doesn't matter, because let's say, sad scenario, in a recovery scenario, $800 million is used to buy back, and it's all done OTC at a really low level. Let's say, $1 or $1.15. Well, first of all, those early holders would be quite upset, right? Because they only made, let's say, 15% having taken this risk, right? That's, I think, an unlikely scenario. I think it will be a higher level than that. But even still, there will only be a certain amount of Leo left afterwards, right? There's only 1 billion Leo. Actually, there's less now. There's more like 995 after the previous buy and burn. So after that's gone, then it's an equity token, right? And now it looks more like a BNB, except there's only, let's say, 300 million left. What's the fair value of that? That looks very interesting.
Yeah, these are all, it's a high quality problem for us as holders if that were to happen, I guess, is the takeaway.
Yeah, exactly. So, I mean, I have thought about the game theory of this a little bit, but I think the reality is, if Judge Cohen comes back and throws out the case tomorrow, where these are rich people problems, I'm not really going to be too concerned about how the funds are bought.
Yeah, I know. I shout out to Catherine Wu. I remember reading her annotated expose of the actual legal docs, and I know you're not a lawyer, and neither am I, but I don't understand why the money wouldn't get returned. Like, what is the major takeaway reason for why the $850 million would not get returned? Do you think, or does it really not matter?
Yeah, so the way I'm thinking about this is this case is for all of crypto. Yes, it involves Bitfinex and iFinex and the operating company, but really this is all about crypto in general. This is a firm which kicked out all of their U.S. users in January 2017. It's been years. And they may, I'm sure they have people from the U.S. that try to open accounts from time to time, and they will always try to go back and find those accounts, block them in any way that they can. But Leo in particular was highly KYC'd. That I can promise you. And for the that also goes for anyone on the platform now, trading any product, right? So for me, the idea that a state attorney general can go after a foreign firm for maybe having users in their state years ago, or maybe recently, but what process needs to be done to mitigate that? And that's highly debatable. But that's a case for all of crypto. And that's a victory for Bitfinex is a victory for all of crypto in my mind. Because you can just go down the list and say, okay, Binance, how they've got 30% of their users in the U.S. right now. They're syndicating IEOs to retail, a lot of which are going to be in the U.S. What a victory for Bitfinex here is a victory for Binance. What about you could just go down the list. You can go down the list of all foreign exchanges, and I think the consistent theme will be when Tether wins, crypto wins. When Bitfinex wins, all of crypto wins.
Yeah, that's a good call. So what's your timeline, do you think, on LEO? Like, are you here to live through crypto capital and watch this thing turn into like a real utility token? I mean, it already is, but and a real equity instrument on Bitfinex, or are you kind of here for the trade? What's your positioning here and how do you think about it, let's say after a potential crypto capital return?
Well, I need to see how that's being done, right? We came up with a couple scenarios, one where they buy on open market, one where they buy OTC. So I would have to see at what pricing that's done. And I do have a model, which I can check and see, what I think is a reasonable, like post collection valuation. But I also, at that very time, I'm also expecting lots of capital to be coming back to Bitfinex as a platform. And when that happens, your utility model needs to change a little bit as well. So yeah, I mean, if the funds are all collected at a low valuation, then I would expect the Leo, equity component of that to be worth a lot, right? And that obviously is worth holding, right? Up to a higher valuation. If it's done at a higher valuation, then you should probably be part of that amount, which sells at that higher valuation. So it's definitely some math that you need to put in there, but it's all these are happy game theory problems.
Yeah, that's a good call. And, when you're thinking through your model here and you're kind of thinking about exchange fees and volumes and all that stuff, and how much of that gross revenue that they make could be used to burn LEO, how do you think through, do you actually think through competition here? Because a lot of the exchanges in the US are like Poloniex just moved to Bermuda, Binance is being geofencing America, et cetera. Do you view that in your model as an uptick in volumes for Bitfinex, or do you view that as negative for everybody? I guess, how do you think through the competitive landscape for exchanges? Because it definitely drives the price of LEO at some point.
Yeah. So I think they're definitely competitors, but there's a lot of stuff that, on the surface looks like competitors, but are really not, right? For example, CME trades, an enormous amount of Bitcoin futures right now, right? That is just not a competitor to BitMEX, which is, nor is it a competitor to the Bitfinex derivatives product. Because anyone that is got a large, a brokerage relationship in the U.S. trading on the CME that doesn't want to touch crypto, right? That's why they would be there to begin with. They surely are not a potential customer to a non-U.S. exchange that doesn't accept U.S. peoples, that's outside of the U.S., that demands that you touch crypto, right? Those are obviously two completely different pools of liquidity. And so I do think there is this trend of, dividing the world of crypto into the U.S. and the non-U.S., and that definitely is a theme of 2019. Bitfinex is obviously not hurt by that at all because they kicked out all their U.S. Traders in 2017. Other exchanges will suffer from that, absolutely, because some have not yet been through that transition, whereas Bitfinex already has years ago. But yeah, I think there is Bitfinex has done a good job of keeping a niche that they do very well in, particularly non-U.S. fiat gateway and spot margin trading. But I think there is an overhang with this court case, which will drive volume back to Bitfinex. And I think there's a number of other products in the pipeline, derivatives, TokenX, and others that will also show quite a lot of promise.
That's excellent. Yeah, no, it's going to be interesting to watch the next couple of months and see how everything plays out. And Kyle, just switching gears a little bit, you have like a very great career and a long-term career in finance, coming from the traditional finance world, where I think a lot of large crypto funds and VC funds are basically crypto native people who, in many respects, are awesome, but made a lot of money and then transitioned into funds. What do you think crypto funds or crypto VC funds are getting wrong that's just blatantly obvious to you as a finance person? Like, anything stand out to you, like weighting or positions or anything there?
I think a lot of them should return the money to investors. I think if you go out and you say you're going to do a certain strategy and you raise money for that, you should do that. if you change your idea and there's strategy drift a year later or 2 years later, you should return the money. And then you should, if it's still a good idea, it turns out you're good at that, then you should raise money again. That's what I think. But I think a lot of people that maybe started as a VC mentality, then started doing a lot of flipping in 2017, and now are transitioning into some view taking here and there, or they claim to be doing market making. I think that is a complete farce. That is that's terrible. Actually, I think that all that money should just be returned, and then it should be reallocated to people that are good at those strategies. If those guys are good, they will raise money. If they're not, it'll get reallocated to other people. So yeah.
No, that's a good call. And to people listening, like there's a lot of funds that listen, a lot of VCs that listen. And I know that you have your views on where you guys spend your time and where you trade and where you guys make your money. If you had to segment the market into VC deals, so early stage protocols, all the way up to more enterprise deals like investing in the BlockFis and the Circles of the world versus liquid tokens and futures trading and borrowing and lending. And I know I'm grouping a lot here. Where do you think the most interesting stuff to make massive amounts of money in? Do you think it's on the VC early side, or do you think it's on the liquid token and everything you guys are doing here?
I think the reality is you don't get to choose where you make your money. I think people are good at certain things because of their history, their firm, their setup, whatever it is, right? So for me, even if I thought early stage VC was a great idea, I can't do it. And that kind of gets to my point, the difference between prop trading your own money and hedge fund trading other people's money. If I'm trading my own money, I'm not going to reach into strategy drift to like early stage VC, right? That'd be silly. I mean, I would surely lose money, right? Even if I thought the asset was a good idea. So when I see across the aisle, people with other people's money trying to do the other way around, it looks equally silly to me in a lot of ways. But yeah, I just don't think that, I don't think you get to choose your alpha in a lot of ways. I think you get to work at it. You get to try a lot of things. But at the end of the day, you're going to be good at something. And what we're good at is derivatives trading, where we have to pair algorithmic trading with some OTC deals that have to be done through a tier one blue chip entity, which we have. And that's why I think we have alpha in the markets. But I wouldn't, other people have their own alpha. Some guys might be really good at early stage VC. Other guys might be really good at, punting on BitMEX or whatever it is. There's many ways, 100 different ways to make money in this world.
No, it's a good call. I mean, I don't think a lot of people are aware of strategy drift because, at first changing strategies or diving into something new seems fun and exciting. And I feel like a lot of people don't realize that it's outside of the core competency of the fund or the person.
Yeah, I think experimenting is a really cool idea if you're doing tech. But experimenting in a fund is a terrible idea, especially if you have other people's money. That's borderline fraud.
No, I'm laughing, but no, you're totally right. And I guess last question for you, Kyle, before we close out, what's something that you think, a view you have that you think is crazy or you don't think people agree with in the crypto world or as it relates to finance, or I guess just something maybe you and Suzu internally go back and forth on that you may disagree on? That would also be something that's interesting.
Well, we do have very heated debates. Anyone that knows us knows that we are extremely aggressive in our views and have no problem just ripping into each other with ideas, with the idea being that conflict yields, some good ideas at the end, right? But I think
that's a really good point. I mean, just from a business and a personal perspective, how do you manage having such heated debates while maintaining a close business relationship? And I feel like this is a question that could apply to people in any business.
Yeah, you have to have respect at all times. So and Sue and I have a long history. We actually went to high school together, college together, first job together. Known him since he was 14. So we, for us, we can have an extremely heated debate, but we always have respect for each other's ideas and opinions, and that's why it works so well, right? Have moved around the world together, have been roommates for a number of years. So it does work well, but I think it's important, right? I think if you don't have someone to debate with, you can end up in some dark alley sometime where your ideas make no sense. Yep. And you're in an echo chamber, right? It's important to get out of the echo chamber sometimes.
Yeah, no, that's super interesting. And I guess, are there any situations where you guys just get into such a debate where you're at an impasse where you can't make an investment or you can't make a call? Like, is the decision then just to do nothing? Or I guess, how does push come to shove at the decision level then?
So our fund, our mandate is to do arbitrage trading. We do have some positions in our fund, but they're not huge positions. The large positions that we're taking are all personal positions, which we do outside of the fund, which makes sense because if you are facing my fund as an entity, which is doing a borrow or lend against it, you don't want me to have some huge positions in our fund. You want it to be a relatively flat fund, right? A market neutral fund, which it is. The large positions that we tend to take are outside of our fund. And then, yeah, we debate things with each other. But if he wants to take a position and I don't agree with it, then he can go do it on his own personal account.
Yeah, no, that's a good call. No, it's interesting. I mean, the constructive dialogue and the arguments are definitely central to getting out of the echo chamber. I feel like a lot of businesses, could delude once they get into that. So it's great that you guys have that. It's super interesting.
I think that the risk is more if you have other people's money, because then there's perverse incentives where you want to keep that money and you're not sure what to do and your alpha has changed. And then you need to, a lot of crazy things can happen, right? You could go in from early stage VC into like an arbitrage trading strategy when in fact you have no expertise there whatsoever, right? Or vice versa. We could go, and we've been burned a number of times too. This has been a learning process, right? We started desks which make no sense, which have lost a bunch of money, and then you have to touch the stove sometimes to realize it's hot. And then when it's hot, you realize maybe don't touch that stove anymore.
Yeah, no, of course. And last question for you, and I don't want to simplify the entire space down to one question or make it sound crazy, but I'd like to get your view. What's your view on the next, 12 to 24 months in the space? Like, do you think that, it's going to be obviously a bumpy ride? Do you think that all these macro issues we're seeing from the trade war, devaluation of the yuan, like that all drives Bitcoin and crypto higher? I guess just what's your quick takeaway on, what you're looking for over the next, year or two?
So for my back book positions, which are, 1 to 3 year positions, relatively sizable, we don't trade them around. We're just long-term bullish. And there's a lot of volatility, but high risk, high return here. So I think the people that I know that have done particularly well in this space, in terms of backbook trading, do not trade it very much. They just hold it, right? And I think that's my mentality too. I think there are certain narratives that play out over the year, but if you just zoom out a little bit and look at a 3 year, 2 year, whatever horizon you're looking at, those just look like little bumps on the graph, right? So, yeah, I think that's kind of the way I'm thinking about it. We do pay attention to the narratives, and Sue does have some comment. I mean, we have some views on them from time to time, but we're really not trading the narratives that much. I just don't think it's a very productive thing to do.
No, that's interesting. And last question, I promise. It's just interesting to have you on. How do you personally get out of the crypto echo chamber for any specific asset? Like you said, you own Bitcoin, you own Ethereum, Leo Dot. Like, I don't want to get into all the narratives, but there's a lot of conflicting narratives between all of these. I mean, I personally own everything you mentioned except Dot. How do you personally zoom out, get away, and kind of make these decisions yourself here?
Well, by the way, I have to comment. You have a fantastic overview of Polkadot, which everyone should take a look at. It's a Medium article. And you have a great podcast, which you just did with Ryan Zer, that is also phenomenal.
I appreciate that. Thank you, Kyle.
Yeah, so the way we think about narratives, or the way I think about narratives, or what to hold is, I'm trying to just zoom out and say, if this were to fail, why would it fail? Because I can just own Bitcoin. I could do 100% Bitcoin. But what if smart contracts do really well? What if that's a really interesting field? And is that team that's working on Bitcoin going to be the only one that's successful? It's possible, but if it were to fail, what would you want to own as a hedge? It's almost like longing for a hedge. And then if Ethereum were to have issues, well, which protocol do you think would be the one that would, have the better tech or the better performance or or in some way? And using that logic is basically how I got into those three positions: the Bitcoin, Ethereum, and then the Polkadot. In theory, I could just own a ton of Bitcoin, but in practice, it's nice to long as a hedge, not shorting as a hedge.
It's a refreshing viewpoint. I mean, I love Bitcoin for the digital gold narrative, and it resonates with me, and I understand it. But I also have a lot of value in, the thousands of and millions of experiments potentially on Ethereum and other smart contract platforms that could yield some serious unknown unknowns. And we already have some pointers that it's successful with DeFi and coming Web3 eventually. But another day on all those topics.
Yeah, and the timing of those are interesting too, right? I think if Polkadot, were 10 years into their development and this was their current state, then I would say, okay, maybe I don't need to own Polkadot. Maybe I can just own, Ethereum, right? But if Polkadot is launching their mainnet end of this year and is doing lots of PR around the launch, and there's some pretty exciting teams that are working on it, and this was also, one of the best Ethereum Foundation grants, or largest that was given, and one of the founders of Ethereum. Well, now the narrative looks a little bit different, right? At least for the next year, and then you have to benchmark it and say, okay, where are they, 3 years from now or whatever. But yeah, I don't know. For me, that's how I get into those conclusions.
No, that's interesting. No, I agree. I mean, people forget that the goal of Polkadot is to be an ETH 2.0 competitor from the start, and ETH is still on 1.0. So, people will argue this. It depends what features Polkadot actually launches with, and et cetera, and how viral it is. But I definitely agree with you. It's interesting. Well, Kyle, this has been amazing. I definitely want to have you on again soon to dive into more specific, and not more specific, just other topics as well. But I really appreciate your time.
Really appreciate it, Tom. Thanks for having me.
And Kyle, just let people know where they could follow you, where they could learn more about 3 Hours Cap.
So my partner is on Twitter, Suzu. And if you wanted to reach out to us, you could come through our website, www.3arrowscap.com.
Yeah, and props to Suzu. He's one of my favorite follows. I feel like I find myself just, weeks down his timeline sometimes.
Yeah, no, he's got a good feed.
Yeah, Kyle, thanks so much, and talk again soon. Hey, everyone, thanks for listening. Do us a favor to support the show and subscribe on Apple Podcasts, and be sure to leave us a 5-star review on the App Store.